Is the trade war as it stands right now starting to infect the broader economy?
Yeah, I certainly think it is, Carl, and I think the president's well aware of that. I gave an interview yesterday where I said, look, this is how he does it. It's uncomfortable for the rest of the world, but we've got a deal, we don't. It switches day to day, and the market needs to be, and I think the market is generally looking out longer term. PMIs, manufacturing, we think are bottoming. The services numbers and the jobs numbers are a little bit disappointing. But that said, the consumer is uber healthy. With strong savings rate, affordable housing, cheap gas. So we continue to be constructive on the markets.
Paul, that is all true, although it doesn't explain why analysts are cutting their Q4 numbers at the fastest rate in a couple of years.
Well, yeah, Q4 is getting cut, but we're more interested in what's going on for 2020, and we think those numbers are still a little bit too high as well. But even again, if you cut those numbers, you'll still get, we think, a reasonable mid-single-digit return next year from the S&P 500. That's not bad in an environment like what we're in right now.
Yeah.
Nancy, how healthy do Christmas season retail sales have to be to perpetuate this story about the healthy consumer and sentiment being so strong?
Well, that's the rub, right? Because the numbers so far look extraordinary, especially online. We have exited some of the names that we were buying a year ago, like Costco, just because valuations have priced in all of the good news. So we think there's still some opportunity there, and retail sales are slowing for sure from the first half of this year, but will remain at fairly high levels. And I think that's what the market's looking at. It's, earnings are being cut. That's kind of old news now. We're looking forward. And I don't expect a robust earnings year, but I don't expect a bust either. I mean, the revenue numbers are still pretty good for most of corporate America.
Paul, we're still lower on the week so far for the S&P, but we've already regained all of the losses from yesterday, and the broader market is up something like 24% year to day. Valuation here, are we still stretched, or does this make sense to you?
With interest rates this low, valuations, you have to give them a little bit of more room to move to the upside. We don't think they're stretched. And we do think there will be, even with modest earnings growth next year and reasonable, we think valuations, you could still get to a 3250 on the S&P by year end.